Waffles, and I'm a government whistleblower turned political commentator, and here are the top economic news highlights for the past 24 hours. Today is December 9, 2025. It is 9:29 p.m. Mountain Standard Time. The stock market closed with the Dow Jones down 0.4%, the S&P 500 down 0.1%, and the Nasdaq Composite down 0.1%. U.S. container imports dropped sharply in November, according to data from Descartes Systems Group. U.S. container imports fell 7.8% year over year in November 2025. Imports from China were particularly hard hit, down 19.7% year over year. U.S. ports handled 2,183,048 TEUs in November, the fourth strongest November on record. The drop signals a softer demand for imported goods, especially from China, which may reflect reduced consumer demand or changing supply chain behavior post tariffs. It may also foreshadow lower import-driven inflation, but could hurt retailers, logistics firms, and import-reliant sectors. No, the reason why people are not, why imports are down is because Donald Trump keeps putting tariffs on everything, making it so nobody can afford shit. That's why. $12 billion emergency aid for U.S. farmers. Donald Trump is trying to fix the damage that he did to agriculture by slapping tariffs on trade with China in particular. So he now has to use our tax dollars to fix the problem that he caused in United States agriculture with his tariff bullshit. And we don't even know if they're actually going to see the money, because that's supposed to be in 2026. Lord knows I sure hope we have a country in 2026. But it's February 2026, I think, is when they're supposed to receive that money. That's just food that went to waste because of Donald Trump and people that did not have food and a driver of inflation. Labor market signals job openings rise, but hiring remains weak. In October 2025, U.S. job openings vacancies rose 7.67 million, a 5-month high, modestly above September 7.66 million. But despite that, actual hiring dropped by about 218,000. The quit rate, often viewed as a gauge of worker confidence, fell 1.8%, its lowest over 5 years. Layoffs rose 4% to 1.9 million, with major companies like Amazon, UPS, and Target among those downsizing. This mixed picture signals possible stabilization in demand for labor, but underlying softness in hiring and confidence could presage broader economic cooling for consumers and workers. This remains a warning sign. Even as vacancies exist, fewer people are finding stable work, and job security appears under pressure. Commodities rally, some industrial and energy-linked prices surge. According to a report today, the Broad Commodities Index, Bloomberg Commodity Index, has hit its highest level since early 2023. Industrial commodity prices, notably copper as well as U.S. natural gas, have surged. Analysts link this partly to demand for clean energy infrastructure, data centers, and increased demand for LNG exports, though some caution it's driven by sector-specific supply-demand dynamics rather than a broad industrial rebound. For the U.S. economy, rising commodity and gas prices may benefit producers and exporters, but for consumers and energy-intensive industries, it could translate to higher costs, inflation in certain sectors, and may remain sticky, complicating monetary policy decisions. Global macroeconomic backdrop remains fragile. Risks persist. A global snapshot published today notes that global markets are navigating a complex tapestry of diverging monetary policy stances, persistent, though slowly normalizing inflation, uneven growth, and geopolitical risk. Rising global debt burdens, especially in mature economies, including the U.S., are contributing to record high global debt near $346 trillion. The report warns that pending decisions, including possible rulings on tariffs and fiscal policies, could create additional debt pressures. Even as parts of the U.S. economy show resilience, structural risks remain. High debt, global uncertainty, and policy-driven volatility could weigh on growth, borrowing costs, and fiscal sustainability going forward. Forecast still modest growth expected, but softening ahead. According to the Conference Board, the U.S. leading economic index, LEI, declined 0.3% in November, a second straight monthly decline, signaling a slowing business cycle momentum. Their outlook, even if GDP grows by 1.8% in 2025, expansion is likely to slow to around 1.5% in 2026. The softness in LEI reflects weak consumer/business expectations, fewer manufacturing, new orders, and adverse yield curve dynamics, all of which suggest a cooling economy ahead. The headline numbers for 2025 remain positive overall, but underlying signals point to sluggish growth, elevated uncertainty, and a risk of an economic slowdown in 2026, particularly if trade and tariff instability persists. The drop in container imports combined with elevated agricultural aid suggests the U.S. economy is being reshaped by trade policy disruption, supply chain shifting, reduced import demand, and domestic sectors like farming under stress. Labor market instability, high vacancies but weak hiring might presage broader economic softness, which could reduce consumer spending and economic growth. Commodity price rallies and rising debt add volatility. While they may help some industries, they raise the risk of inflation, rebound, or cost shocks of others. With leading indicator declines and modest GDP growth forecast, 2026 may be a year of constrained growth, especially if trade, fiscal, and monetary policy remain unsettled. The Consumer Financial Protection Bureau, CFPB, is to issue an interim final open banking rule amid funding shortfall. The CFPB announced it will release an interim final regulation governing open banking and consumer data rights because it expects to exhaust funds by December 31st, 2025. The move comes as the agency has rewritten previous data sharing rules under current leadership, which supports lawsuits from banking groups challenging the earlier regulations. With limited time funding, the revised rules may end up weaker than prior protections, raising risk for consumer financial data privacy, fintech access, and regulatory clarity in banking and the financial sector. Banks get looser leverage, capital reserve requirements, system-wide banking regulatory change as of late November, still shaping markets now. U.S. regulators approved relaxed leverage requirements for large banks, reducing required capital cushions, a major shift in banking regulation. While intended to spur growth and ease constraints on bank lending, critics warn this increases systemic risk in times of stress and weakness and weakens financial system safeguards. This regulatory change could affect credit availability, mortgage financing, and potentially long-term financial stability in the U.S. Alchemy Technology, fintech banking firm targeted by activist investor for sale, highlighting pressure in financial tech and banking service sector. On December 9th, activist investor urged Alchemy Technology, a fintech service provider to banks and credit unions, to explore a sale, citing 40% drop in its stock this year. This points to stress in the fintech banking interface, perhaps reflecting tighter credit conditions, regulatory uncertainty, or diminished investor confidence, all relevant to the broader economy and consumer financial services sector. Potential but uncertain easing of U.S. tariffs on Swiss goods, diplomatic and trade implications. Reports emerged that the U.S. intended to retroactively reduce tariffs on Swiss imports from 39% to 15%, effective November 14th. However, the Swiss government later rejected or withdrew the statement, casting doubt on whether the tariff reduction will actually take effect. The uncertainty around U.S.-Switzerland trade relations could dampen cross-border trade and investment decisions, especially for industries relying on Swiss-U.S. supply chains, luxury goods, specialty manufacturing, etc. Mortgage rates remain high and volatile. Housing and borrowing conditions stay challenging. As of today, various measures report national 30-year mortgage fixed rates around 6.21% and 6.32%, with some variation by lender and loan type. Given the expectation of the upcoming interest rate decision by the Federal Reserve, many borrowers face uncertainty. A potential Fed cut may or may not translate quickly into lower mortgage rates. High rates continue to suppress affordability for home buyers and make refinancing unattractive, which weighs on the housing market, demand, and broader consumer financial health. Regulatory shifts, CFPB's weakening banking and capital loosening change the institutional rules of the road, affecting financial sector stability, consumer protections, and access to credit. Uncertain tariff diplomacy, like with Switzerland, adds unpredictability for trade, supply chains, and export and import industries, undermining business planning. High borrowing costs maintain pressure on consumers, mortgages, and loans, suppress housing demand, and strain household budgets, which could feed into slowing consumer spending and broader economic softness. Markets, interest rates, and financial market positioning ahead of key Fed decision. As of today, bond and money market investors are largely betting on a rate cut from the Federal Reserve. But many analysts expect only a shallow easing cycle, perhaps a cut this week followed by a pause. Potential for mild easing, but financial stability and inflation remain key headwinds. They're just going to bleed the economically disadvantaged dry, is what they're trying to do with this Fed rate cut, when what they need to do is tax the rich and get rid of the fucking tariffs. They're just going to try to stimulate the economy by robbing people using the debt system. People who are likely already victims of financial crimes being committed by this administration. If the Fed cuts rates, it could ease borrowing costs and support consumption and investment, but a cautious outlook, the one cut only in 2026, suggests policymakers remain very wary of inflation and long-term financial risks. Global debt levels and corporate bond issuance remained elevated. Broader financial system risk. A recent report flagged that global debt, public and private, has pushed near $346 trillion. Trump is currently destabilizing the global economy. CITI expects a surge in investment banking fees amid robust deal-making. Citibank's CFO said on December 9th that investment banking fees are likely to be up mid-20% year over year for quarter four, reflecting continued deal and M&A activity. Markets revenue may decline slightly, but the strength in underwriting suggests capital markets remain active despite macroeconomic uncertainty. Major U.S. banks signal AI-driven productivity gains, but also warn of job losses. Leading banks, including J.P. Morgan and Chase and Wells Fargo, said this week that AI deployment has boosted productivity. J.P. Morgan reporting a rise to 6% productivity versus 3% prior year, but also may lead to job cuts as efficiencies replace some roles. Markets remain jittery as the Federal Reserve enters a critical policy meeting to discuss whether or not they're going to try to defraud disadvantaged Americans by luring them into taking on more debt in a unstable economy with high inflation. Well, and that includes the economic report for today. I'm going to go now. Bye.
So the Olympics is great. And Johnny, for the others, you know, the World Cup, Johnny is the head of it. We had our top people, Wasserman. They all came in on the Olympics, and then I saw Johnny. And we got the World Cup, too. And, you know, it's only because they rigged the election that I'll be your president representing you there. You know, I got both of them. I got the Olympics, and I got the World Cup. And I said, you know, it's too bad. One was in 2026 and the other was in 2028. And I said, I won't be there. I won't be your president. But then they rigged the election and now we won. So I'm going to be your president for the Olympics and for the World Cup. So Johnny, thank you for the World Cup. And everybody, thank you for the Olympics. We're going to have a great time.
Hey guys, don't forget to like, share, subscribe, and comment on my videos. And also, don't forget to check out my shop where you could get this awesome Real Patriots Punch Nazis t-shirt. America, fuck yeah! And if you go to the link tree in my bio on most platforms, it's got links to everything, all of my stuff. You can find my shop there. I'm on eBay. You can also get this cool Exterminate MAGA sticker, cause MAGA's fucking cockroaches, and fuck MAGA, abolish MAGA, fuck you MAGA.